All right, so in this video, I want to think about how we can classify government spending and taxation as either fiscal policy or non-fiscal policy, and within fiscal policy, how we can further break it down into either being expansionary or contractionary, or being a discretionary fiscal policy or an automatic stabilizer. So I'm going to provide an illustration, a tree diagram coming up, which I'd recommend replicating in your own handwriting because it's a little bit hard for me to draw on a tablet here, but hopefully you'll see the thought process in how we can categorize different forms of spending. And then we're going to move on to analyzing what challenges face fiscal policy and what limitations we may have from a central government standpoint in using fiscal policy to impact the economy. So I think this video is important so that once you understand the presence and the impact of automatic stabilizers, you can predict economic resiliency to shocks to the economy based on your understanding of what automatic stabilizers are already in place or being discussed to be put in place. And once you know the challenges of good fiscal policy, then it's important to know what the solutions to those challenges are so that you can be informed as to whether fiscal policy should be supported in a given instance. And lastly, it's a goal of this class for you to be able to determine if specific spending or taxation would be considered fiscal policy or not, and hopefully the tree diagram coming up is going to be helpful for that sort of classification for you. So we want to think of discretionary fiscal policy as being the passing of a law which would directly change spending or taxes. And we're going to contrast that with automatic stabilizers. And automatic stabilizers are going to be policies which immediately kick into effect and are triggered by some sort of macroeconomic indicator. And so these are going to immediately change taxation or government spending due to changes which are in the economy. So some examples of these would be unemployment insurance or supplemental nutrition assistance program, which is SNAP, which is more commonly known as food stamps. And these are triggered by changes in individual income, as we saw actually in the previous video when we thought about the effective marginal tax rate, which someone with one child and no other income earner would pay as their income falls below a certain level, or what the benefits they would receive when their income falls below a certain level. And so historically, these automatic stabilizers, these policies which kick in as soon as a threshold is crossed, have offset of about 10% of the initial change in output. And so if we are sliding into a recession and people start losing their jobs left and right, and that should be causing their consumption to decrease even further, their ability to automatically be able to collect, in theory, automatically collect unemployment insurance and food stamps would prevent them from spending even less money, which would prevent us from falling into an even deeper recession. And so on the next slide, the next image, I want to actually explore these differences more spatially using that tree diagram approach. And I'll recommend that you replicate this next diagram in your own handwriting, since mine is a little limited by space and writing on a tablet. So to preserve a little bit more space, I'm going to get rid of my beautiful, big, shiny, bald head again and just fill up the whole screen with writing here, but rest assured I'll be right back after that. Okay, so I think it's pretty easy to get confused about what type of government spending is considered fiscal policy and what type of government spending and taxes are not considered fiscal policy. So I think what's going to be most helpful here is to think of a tree diagram where we consider all types of government spending and taxes. And the first question we need to ask ourselves is, are these taxes and does this spending is it intended to influence short-term economic equilibrium? So if it is not intended to influence short-run economic equilibrium, then it is not fiscal policy. And this doesn't mean that it's not valuable forms of government spending. So examples here would include the Environmental Protection Agency, the EPA, the Department of Housing and Urban Development, HUD, so making sure that people have adequate housing, making sure that the environment is not degraded and is protected. And these are both, very important forms of government spending, but because they're not intended to influence the equilibrium of aggregate supply, aggregate demand framework and our economic growth, they're not considered fiscal policy. So that means that another type of government spending necessarily then, if it is intended to influence the short run, I'm just going to say SR, economic equilibrium, then it is fiscal policy. And remember, we have two types of fiscal policy. And we can think about whether that fiscal policy requires new legislation to be enacted. And if it does not require legislation to enact the fiscal policy, then this is considered an automatic stabilizer. And the examples of automatic stabilizers include unemployment insurance, as well as SNAP benefits, meaning food stamps, a supplemental nutrition and assistance program. And we say that these generally offset about 10% of the change in the economic conditions that are due to external forces. And so, on the other hand, then, if new legislation is required, we'll say a law is required to enact policy, then this is considered discretionary fiscal policy. And we have two types of discretionary fiscal policy. We have expansionary and contractionary. So if it's intended to fight unemployment, then it's going to be expansionary. And this is going to require either decreasing taxes or increasing government spending. Now, on the other hand, looks like I left off a T there. If it is intended to fight inflation, sorry, having a little bit of problem here. fight inflation, then it's going to be contractionary. And contractionary policy is going to require either increasing taxes or decreasing government spending. All right, so I think this is hopefully a helpful way of visualizing what types of government spending classify as fiscal policy, what types do not, as well as what types of government spending are considered automatic stabilizers versus discretionary fiscal policy, and what is expansionary and what is contractionary. Yeah, I apologize if the handwriting here is a little bit unclear. That's unfortunately the situation we find ourselves in, but hopefully you can try to replicate this diagram in your own handwriting and use it as a way to be able to classify government spending as fiscal policy or not. Okay, so we want to think of a couple key limitations to using fiscal policy as a way to improve the economy, either to increase GDP or to cool down the economy and limit inflation. So we're going to think of two types of lags, and just here we mean delays, and one of which is going to be recognition, the other is going to be implementation. So the recognition lag is going to refer to the time that it takes for legislators, for policymakers, to notice that we are moving away from a desirable equilibrium. And so because economic statistics are only reported at different time intervals, so we can collect unemployment insurance claims every week, data on those claims every week, we aren't going to know specific unemployment statistics reported by the BLS but once a month. And statistics on GDP are released officially 4 times a year. So while we're waiting between those intervals, the economy may be worsening, and Congress or state legislators may not have the information that they need to say, hey, we need to enact this policy now. Even once they know what is happening, if there was to be no recognition lag, there would still be an implementation lag with discretionary fiscal policy. That once Congress passes a stimulus policy, all of that, the funding, all the government spending isn't going to get into the hands of consumers or of firms immediately. That there's going to be maybe an application period, there's going to be some bureaucratic period where it's going to take a while for the government to disperse the refund checks, the stimulus checks, that if there's a policy such as cash for clunkers, people aren't going to be able to immediately sell their car for $3,500. They may need to drive it a little bit longer until they have enough money to pay for the balance on a new car, and that's going to be our implementation lag, the time that it takes after a policy is put in place, but before the money gets into the hands of the people. And so we'll think about what possibilities there are to overcome these limitations, but just know that these are they're valid critiques of fiscal policy if not done properly. And in addition to these two lags, there may be an impact on economic growth due to more spending leading to less balanced budgets. And so there's been some findings that a 1% increase in deficits, so the annual difference between government tax revenue collected and government spending, may lead to a percent change in GDP of about 0.5 to 1%. So for every 1% increase in deficits as a percent of GDP, we may see 0.5 to 1% increase in interest rates. And then this would then crowd out private investment for firms and households, meaning that households which would have been looking to either buy homes or cars, or firms which would have been taking out loans to invest in plant and equipment, had the interest rates been lower, may not be willing to do that now that the interest rates are a little bit higher. The quantity demanded of financial capital would decline. So that's a theory of what can happen to interest rates and crowding out. And we're going to discuss the national debt next week, as well as this crowding out effect in a little bit more detail. So I want to think about some of these limitations to fiscal policy, these challenges facing fiscal policy, and think about whether, specifically here, good fiscal policy can overcome these limitations. And so the first limitation is that it's difficult to model. And so I'm going to say that this limits the effectiveness of fiscal policy a lot. That when we think of our model of the macroeconomy, and obviously the model that the Federal Reserve uses, the Bureau of Economic Analysis, the Congressional Budget Office use, is going to be very different from our simple aggregate supply, aggregate demand model. But the central challenge remains the same. How do we fit an equation to either of these two lines such that we can be confident what the equilibrium would be? And so that's a very challenging task when we think about 330 million individuals, countless companies, different states all operating with their own budgets and different levels of federal government. It's an extremely Herculean, maybe even Sisyphus. Boy, I should probably edit that out. The Greek mythology of the guy pushing the boulder up the hill only to have it fall down every day. So it's a virtually impossible task to do it perfectly. However, as we've said earlier in this class, specifically when thinking about macroeconomic modeling, we don't want the perfect to be the enemy of the good. And we can still, there are costs to inaction, and we don't have to get it perfect to offer an improvement upon the status quo. So I think that good fiscal policy can mostly overcome the limitation of the difficulty of modeling the macroeconomy, as long as we are closer to the correct answer than doing nothing, which isn't always that hard to do. So we also want to think about the recognition lag as representing a limitation to effectiveness, as well as the implementation lag. And so when we think about how much does this limit effectiveness, I want to think neither of these limit effectiveness by a ton. And if we use automatic stabilizers, then they won't limit the effectiveness of good fiscal policy. That since automatic stabilizers automatically kick in, they're automatically triggered when certain economic thresholds are crossed, then we don't need to worry about recognition lag or an implementation lag, because those policies would immediately go into effect. So if we have good enough automatic stabilizers, then we don't really have to worry about those lags. Rational expectations, Ricardian equivalence. This, if any of you have noticed in the news recently or any time surrounding the question about whether we should increase government spending as a way to fix a short-run economic problem, and in the readings this has come up as well, there is the rebuttal that, look, we're all hyper-rational individuals. We know that in the long run, governments have to run federally balanced budgets, and that if we increase government spending now, then we're just going to have to increase taxes later. So people aren't actually going to go out there and spend their money, because they're going to save it for future increases in taxations to pay for this. So you could come up with fancy equations that could make that work, and people certainly have. But empirically, individuals don't behave that way. And we know that from years and years of data. We know that from the video that we saw at the beginning of this week on the impact that presidents have on the economy, that 30 cents of every dollar which the government distributed in the stimulus checks in the summer of 2020 immediately was spent in the first 10 days. So those weren't households saying, I'm going to have to pay this back eventually. Those were households saying, I have bills to pay now, I need food, and they were going to go out and spend that money. So I'd say that this does not impact the effectiveness of fiscal policy, and that good fiscal policy can absolutely overcome this limitation. Now, this last question, I think, is really the tricky one. That when we think about whether the debt presents a challenge facing good fiscal policy, I really want to leave this question up to next week. But for now, we can at least distinguish between a political limitation and an economic limitation. So does the concern of running up the national debt, of increasing the national debt, limit the effectiveness of fiscal policy? And we'll say politically, a ton. So we've seen years and years now of unnecessary debates in Congress over whether we should increase our debt ceiling, or we can't spend more because we can't afford it. We're placing a burden on our future generations, and that prevented us from spending money that could have actually helped people get out of economically dangerous situations. And so that political concern here is real, but good fiscal policy can absolutely overcome the limitation of the national debt. So we're going to summarize all of this by saying that good policy can overcome many of the theoretical limitations, but we still need another option to deal with some of the practical challenges. Some of the practical challenges here being political, being that there may be an impact on interest rates if we're spending more. And so the only other option that we have at our disposal from a central government standpoint is going to be monetary policy. And to discuss how we can use the banking system to fix the economy, we first need to understand banks and money. So in the next couple of videos, we're going to consider what money is, and then how banks actually create money, and how we can use the creation of money to improve or just basically try to direct certain levels in the economy, whether that be inflation or unemployment or economic growth. So I will see you in those videos.